I'm back, baby.
Hello, and welcome to the second episode of the Canadian Portfolio Manager podcast, where we help you better understand and manage your ETF portfolio. I'm your host, Justin Bender, and I'd like to start off by thanking everyone who listened to our debut podcast and sent us their feedback. It's great to have you back for episode 2. Today we're going to chat about tax loss selling, a strategy investors can use to defer taxes on their capital gains. No one likes losing money on an investment, but sometimes realizing capital losses can enhance your bottom line by reducing your tax bill while you patiently wait for markets to recover.
You're not a bunch of losers.
No.
You're a bunch of winners with no winnings.
That's true. It's true.
Tax loss selling, also known as tax loss harvesting, is a technique for realizing or crystallizing capital losses in your non-registered accounts so they can be used to offset taxable capital gains. To be clear, there is no benefit to tax loss selling in your TFSA or RSP. This entire conversation only applies to your non-registered accounts, where deferring capital gains taxes can give your money more time to grow. As an example, suppose you invest $100,000 in a Canadian equity ETF, and then the value declines to $90,000. By selling your shares, you can crystallize a capital loss of $10,000 and potentially use that loss to offset a $10,000 capital gain elsewhere in your portfolio. By deferring thousands of dollars in taxes, there's more left in your portfolio to compound over time. Tax loss selling may sound like the cardinal sin of selling low, but we'll explain in a moment why, when properly executed, that's not the case. Before engaging in tax loss selling, it's important to ensure your tax strategy is based on accurate information. It's your responsibility, not your brokerage's, to ensure your ACB or adjusted cost base is accurate and up to date. This includes making adjustments for buys, sells, drips, return of capital, reinvested distributions, and unit splits. For more details on how to track your adjusted cost base, please feel free to download our white paper, as easy as ACB. When you file your tax return, any capital losses must first be used to offset capital gains you've incurred in the current tax year. Any remaining losses can be carried back for up to 3 years or carried forward indefinitely to offset future capital gains. And to carry back current capital losses to prior years, you need to file Form T1A, Request for Loss Carryback, with your tax return. Now back to that selling low conundrum. You may be wondering if it's wise to realize a capital loss by selling a security that plays an important role in your portfolio. If you're holding individual stocks, it probably isn't very wise. Say, for example, your Royal Bank shares are down in value, and you sell them to capture the capital loss. What if you then end up missing a big upward move in that stock? To harvest a loss but not lose your position, you might figure you'll just turn around, buy back more Royal Bank shares at the new low price. Nice try, but the Canada Revenue Agency would declare your sale a superficial loss, and you wouldn't be able to use it to offset gains. This is why investors who buy individual stocks have limited opportunity for tax loss selling. And it's yet another way ETF investors have an advantage. By following the techniques in this episode, you can systematically harvest capital losses, maintain constant exposure to all the asset classes in your portfolio, and comply with CRA rules. Let's take a closer look at that superficial loss rule. Again, the CRA does not allow you to sell a security to crystallize a loss, immediately buy it back, and continue to hold it. If you do that, your loss will be denied. Bottom line, the CRA doesn't think much of you playing shell games with your taxable holdings, so they require you to abide by a 2-part superficial loss rule. And by the way, you also includes people affiliated with you, which includes your spouse or a corporation controlled by either of you. Whoever you are, you A, cannot buy or have the right to buy the same or identical property during the period starting 30 calendar days before the sale and ending 30 calendar days after the sale. And B, you also cannot still own or have the right to buy the same or identical property 30 calendar days after the sale. In Part A of this rule, the period spans 61 days. The settlement date of the sale, plus the 30 calendar days before and the 30 calendar days after the settlement date. Part B sounds redundant, but there's an important subtlety. You can buy the identical security anytime during the 61-day period, but you must ensure you don't still own it by the end of the period. If you do, the loss will be denied and added back to the adjusted cost base of the identical security. The 61-day period includes the settlement date of the sale as well as the 30 calendar days before and after the settlement date. We suggest first using your computer's calendar to determine the settlement date of the sale. For an ETF, this is T+2, or 2 business days after the initial trade. When determining settlement dates, skip over any weekends or holidays when the Canadian stock markets are closed. Next, count backward and forward 30 days starting at the settlement date. I'm not ashamed to admit, I count the days out loud like a first grader when determining the 61-day period. Ensure all purchases of the identical security settle outside of this 61-day period. That is, unless you plan on selling the shares before the end of the 61-day period. The good news for ETF investors is that you can avoid the superficial loss rule while still maintain exposure to the same asset class by using similar but not identical holdings. Remember, the superficial loss rule only applies if you sell and then repurchase the same security or an identical property. And FYI, in 2001, the CRA issued a bulletin stating that 2 index funds tracking the same benchmark are considered identical property. For example, according to this interpretation, you can't sell the iShares Core S&P TSX Capped Composite Index ETF, XIC, and just replace it with the BMO S&P TSX Capped Composite Index ETF, ZCN. That's because they both track the S&P TSX Capped Composite Index. Other less obvious examples of identical property would include the Mackenzie Canadian Equity Index ETF, QCN, and the TD Canadian Equity Index ETF, TTP. They both now track the Solactive Canada Broad Market Index. Vanguard, BMO, and iShares all have funds tracking the S&P 500 Index, and these would also be considered identical property according to the CRA. However, it is possible to find pairs of ETFs in the same asset class that are similar but track different indexes. By selling your existing ETF and repurchasing a similar but not identical property, you can realize a capital loss and still maintain similar exposure in your portfolio. Identifying acceptable pairings can be time-consuming. Stick around for the rest of today's podcast, and we'll suggest some specific ETF pairings for your consideration later on. Before we go there, we've got a lot more ground to cover on your overall tax loss selling strategy. First, as your replacement ETF is a similar but not identical holding to your original ETF, it's unlikely the pair's performances will be exactly the same over the 30-day period. So what do you do if your replacement ETF dramatically over or underperforms your original ETF during the holding period? To illustrate, let's say you took a much-needed break from your in-laws on Christmas Eve 2018 to check on your portfolio. You then discover your $100,000 holding of the Vanguard FTSE Canada All Cap Index ETF, VCN, has dropped to $84,000. You sell all units of VCN and use the proceeds to buy the iShares Core S&P TSX Cap Composite Index ETF, XIC, realizing a $16,000 loss in the process. After 30 days have passed, you sell your XIC holdings and repurchase VCN. During this 30-day period, the replacement ETF happened to outperform the original ETF by about 0.15%, including dividends. This doesn't seem like much, but on an $84,000 holding, it means you scored an extra $122 from your tax loss selling round trip. This is an ideal result, but things don't always work out so well. There's also a risk the replacement ETF will underperform the original ETF during the 30 calendar days after the switch. If properly selected, your tax loss selling pair should have minimal tracking error with minimal performance differences between them. This low tracking error is also a good reason to consider holding on to the replacement ETF instead of switching back to your original ETF after 30 days. If both ETFs are expected to perform similarly going forward, and there's no way to determine which will slightly outperform the other over your investment horizon, you're really just flipping a coin at this point. It's also possible to trigger a partial superficial loss, whereby only a portion of the capital loss is denied. This would occur if you or yours, as previously defined, buy back fewer shares of the identical property during the 61-day holding period, and you're still holding these shares at the end of the period. This can easily occur when a tax loss selling trade is made at year-end. When January arrives, investors and their spouses are busy making their TFSA contributions, simply topping up whichever asset class is down in value. Surprise, surprise, this is often the same security they sold in December to realize a capital loss. For example, you purchased 3,000 shares of VCN in 2018 for $100,000. On December 24th, you sell all 3,000 shares for $84,000, resulting in a capital loss of $16,000. You immediately purchase XIC with the proceeds. On January 9th of the following year, which is still within the 61-day period, your spouse makes an annual TFSA contribution and buys 300 shares of VCN, which is the same security you just sold at a loss in December. Your spouse continues to hold these shares until after the 61-day period ends on January 27th, 2019. Whoops. As your spouse purchased back 300 of the 3,000 shares you initially sold, 10% of your $16,000 loss will be denied. This will result in a partial superficial loss of $1,600, reducing your actual $16,000 loss to $14,400. Some spouses prefer to keep their finances separate, but this example illustrates the need for spouses to coordinate their investment strategies, especially when tax loss selling. Enrolling in a dividend reinvestment plan or DRIP program through your brokerage account is also a surefire way to realize partial superficial losses. If you or your spouse have a DRIP set up on the same ETF that you decide to sell for tax purposes in your non-registered account, a portion of the loss may not be allowed. This is why we advise against using DRIPs when implementing a tax loss selling strategy. Continuing with our example, suppose your spouse also owns 3,000 shares of VCN in a TFSA that he or she purchased outside the 61-day window. In January 2019, your spouse receives a dividend from the fund, most of which is used to automatically purchase 20 additional shares of VCN. If these 20 shares are not sold by the end of the 61-day period, you've just triggered another partial superficial loss. Last but not least, having multiple portfolio managers can also cause unintended superficial losses. Some investors feel that using more than one manager offers some diversification benefit. The problem is, it can cause major headaches when it comes to avoiding superficial losses. If one of the managers sells a security to realize a loss, there's no way for them to know whether another manager is buying shares of the same security during the 61-day period. Okay, so we've now covered several important ways to avoid taking superficial losses as part of your tax loss selling strategy. These include keeping an eye on buying and selling similar but not identical ETFs, avoiding partial superficial loss traps, and skipping DRIP programs as well as multiple portfolio managers. In our next segment, we'll go over tactics on when and how to apply tax loss selling to begin with in Part 2. When should you sell your losers?
Well, let's get out the old stock ticker and have a look. Here's where I stopped checking it last time, September 1929. Oh no. Oh no. Oh no.
So now you know the basics of how a market downturn can actually be a tax savings opportunity in disguise. Now you may be wondering, how often should you check your portfolio for these opportunities, and when does it make cost-effective sense to take them? Many investors and advisors pay little attention to tax loss selling until year-end. By doing so, they miss opportunities that arise from market downturns throughout the year. Consider an investor who purchased 100,000 of the iShares Core MSCI Emerging Markets IMI Index ETF, XEC, in April 2013. XEC was significantly down in the third quarter of the year, but during the fourth quarter, it made an impressive recovery. Our investor could have crystallized a loss of more than $6,000 in July or even August, but by the end of the year, the opportunity had vanished. This is why we recommend keeping an eye on your non-registered accounts year-round, not just in December. Pay particular attention when you know your holdings are probably taking a hit. Market downturns aren't usually a big secret. Next, how big of a capital loss do you need to realize to make it worthwhile? As there are additional trading costs of the strategy, such as bid-ask spreads and commissions, it should be large enough that the ongoing tax benefit easily outweighs the one-time expenses from implementing the strategy. In his book, The Only Guide You'll Ever Need for the Right Financial Plan, Larry Swedjo suggests 2 requirements that should be met before engaging in tax loss selling. The security should have a minimum dollar loss of $5,000 and a minimum percentage loss of 5%. As an example, suppose you originally purchased 100,000 of the Vanguard FTSE Canada All-Cap Index ETF, VCN, in your non-registered accounts, and your holding is currently showing a dollar loss of $5,000. calculated as the market value minus the book value. This loss meets the minimum dollar threshold of $5,000. VCN also has a percentage loss of 5%, which is the $5,000 loss divided by the $100,000 book value. This loss also meets the minimum percentage threshold of 5%, so both rules have been satisfied. To realize a loss, you could sell all your shares of VCN and immediately purchase an equivalent amount of a similar but not identical security. So why do we prefer Swedrow's double barrel rule better than a single shot at a threshold dollar amount of loss? Because otherwise, bid-ask spreads can add up too quickly. Requiring a percentage threshold ensures that ETF trading costs won't offset the potential tax advantage. Let me explain. Without a rule specifying a minimum percentage loss on a security, a $5,000 loss on a $100,000 holding would be treated the same as a $5,000 loss on a $1 million holding. In both cases, the tax deferral benefit is the same, but the bid-ask spread cost on the larger holding will be 10 times higher. So, if the bid-ask spread cost of a $100,000 tax loss selling trade is $160, its cost would increase to $1,600 for a $1 million tax loss selling trade. A trading cost of this magnitude would certainly offset the tax benefit for many years. There's another consideration that factors into how successful your tax loss selling tactic will be. It's whether or not you get lucky during the 30-day holding period. This is why we currently use Swedrow's 5% tax loss selling threshold with our PWL Capital clients, but with one minor tweak. If we're planning to switch back to the original ETF after 30 days, we increase the minimum dollar loss and percentage loss thresholds to $10,000 and 10% respectively. This adjustment considers the impact a strong market recovery during the 30-day holding period could have on the results of our strategy. Market recoveries during the 30-day period can be bittersweet. It's sweet that your portfolio value's up, but you'll face a bitter capital gain when you switch back to your original ETF after 30 days. This can offset some or even potentially all the benefit from your initial tax loss selling trade. Imagine you sold $84,000 of VCN on Christmas Eve 2018 at a loss of $6,000 and replaced it with XIC. In January 2019, the Canadian stock markets experienced an impressive recovery. If you had sold your replacement shares of XIC after 30 days, they would have been worth $93,000, resulting in a capital gain of $9,000, which more than offset your initial $6,000 capital loss. Had you instead increased your tax loss selling threshold to $10,000 and 10%, this situation could have been avoided. A significant recovery in the markets is hardly the worst thing that could happen, but it would still defeat the purpose of tax loss selling. This is another reason to consider not switching back to your original ETF after the 30-day period has passed. If this is not possible, consider increasing your tax loss selling dollar and percentage thresholds to $10,000 and 10% respectively. When we introduce you to our tax loss selling pairs later in the show, we'll let you know which of the original ETFs you should probably switch back to after 30 days and which replacement ETFs you could consider holding for the long term. Now, you may also be wondering if you should realize losses whenever the opportunities present themselves. I've heard advisors say that it only makes sense to realize capital losses if their clients have already realized capital gains in the current year or in the 3 prior years. They see no benefit to banking capital losses for later use. I disagree with their logic for a number of reasons. First, many Canadian-listed ETFs tend to distribute capital gains at year-end, and these gains can be significant. By anticipating the need for capital losses to offset gains from these transactions, you can leave more money in the portfolio to grow. Second, most investors will need to periodically rebalance their portfolios by selling equities, which will usually trigger capital gains in the process. Having an arsenal of capital losses to offset these gains will also come in handy when filing your future tax returns. And finally, having capital losses carrying forward provides you with more portfolio management options. As new and improved ETFs are released, you may want to switch from a more expensive, less tax-efficient ETF to a cheaper or more tax-efficient ETF at some point in the future. We experienced this with our PWL clients when some Canadian-listed international equity ETFs began holding individual stocks directly back in 2014, making them more tax-efficient. For those clients with capital losses in the bank, it was easier to switch to the better products with fewer capital gains implications. We're now nearly finished talking tax loss selling tactics, after which we'll have a little fun with the return of my exclusive ETF Kombat face-off. But first, to put my tips into context, I thought you might appreciate hearing some additional perspectives on how to implement tax loss selling. For that, I've brought in a couple of tax loss selling professionals to discuss their strategies.
And it's gone.
What?
It's gone. It's all gone.
What's all gone?
The money in your account, it didn't do too well. It's gone.
First up, James Gauthier from Canadian robo-advisor Just Wealth has been kind enough to share how they manage tax loss selling over at his firm. We'll then hear from Shannon Bender, who will offer more insight into how we execute tax loss selling in our PWL Toronto office.
Hi, this is James Gauthier. I'm the Chief Investment Officer at Just Wealth, an online portfolio manager operating in all 10 provinces across Canada. Thanks, Justin, for inviting me to contribute to the discussion on tax loss harvesting. We think there are basically two approaches used for tax loss harvesting: frequent or infrequent. Frequent tax loss harvesting is performed by an algorithm. It's still relatively new, and we think it has a few drawbacks. The rules used to trigger tax loss harvesting trades are applied universally and without interaction with clients. Tax loss harvesting is either turned on or it's turned off, and everyone's treated the exact same regardless of their taxable position. Also, the outcome of tax loss harvesting using this approach is completely unknown. You hope that the algorithm is going to work, but we would suggest that hoping and investment strategies typically don't go too well together. Infrequent tax loss harvesting, by contrast, happens at a point in time, typically annually. The benefit of this approach is that the amount of tax loss harvesting is known, and you can use this information to interact with clients or their accountants and decide on how this might impact their overall taxable situation for the year. For this reason, the annual tax loss harvesting exercise typically occurs towards the end of the year when clients have a better sense of their annual taxable position. This is why the latter part of the year is sometimes referred to as tax loss harvesting season. We prefer the certainty and customization aspect of this approach and are currently working on our annual process as we speak. We perform tax loss harvesting on all non-registered accounts, but we do set a minimum loss threshold to make transactions material. We will adjust the threshold from year to year based on how the market has performed. This year, we're expecting the threshold to come in around $1,000. To implement, we will perform a same-day swap by selling the security with a tax loss and purchasing a similar but non-identical substitute security so that there's virtually no disruption in market exposure. Once 30 days have passed, we will look to reverse the trades, avoiding any superficial loss. In cases where the substitute security gains more in the 30 days than the actual loss that was realized, we will consult with clients on a one-to-one basis on how best to proceed. That's pretty rare, but it does happen from time to time, and we could end up keeping the substitute security temporarily or indefinitely. So it makes good sense to put the time and effort in to make sure you have good substitute securities selected. That's a quick insight into our process. I hope everyone finds the information useful, and thanks again for having me.
Shannon, now on to you.
Hi, this is Shannon Bender, Portfolio Manager at PWL Capital in Toronto, here to share with you our team's tax loss selling strategy. First, to implement tax loss selling, we need to know as much as possible about the client's tax status. And this begins with running retirement projections, which is going to give us a better understanding of a client's future tax rates. We also ask clients to authorize Level 1 CRA access for us, so we have view-only access to several details about their tax status. We want to check out their net capital losses carrying forward, their taxable capital gains from the prior 3 years, and their tax returns from these years. This information helps us determine their historical tax brackets when offsetting prior capital gains. As Justin mentioned, we look for tax loss selling opportunities year-round, not just in December, so we can realize losses that may no longer be available to us at year-end. To identify opportunities, we use in-house tax loss selling software to generate a list of all taxable ETF positions, showing a loss of at least $5,000 and 5% of book value. Justin also described why we use the combined 5,000 and 5% thresholds to manage upfront bid-ask spreads costs. The software also enables us to adjust our thresholds to 10,000 and 10% if we're planning a round-trip harvest, which basically means that we're buying back the original ETF after 30 days. However, as our latest ETF pairs are so similar, we generally stick with the replacement ETF unless another tax loss selling opportunity presents itself after the 30 days. So that's the broad sweep of our tax loss selling process. But before we proceed with any trades, we're also generating a transaction history for all family accounts. So this will include corporations, trusts, RESPs, TFSAs, and RRSPs. We're looking for any purchases of the target ETF that have occurred in the 30 calendar days prior to the settlement date of the proposed trade. If we identify any trades that could cause a full or partial superficial loss, we'll decide on a case-by-case basis how best to deal with this issue. For corporate accounts, we generally won't engage in tax loss selling, preferring to tax gain harvest instead. Corporate tax gain harvesting involves selling an ETF at a gain, thereby increasing the notional capital dividend account by half of the gain. Tax-free dividends can then be distributed to shareholders up to the available balance in the capital dividend account. Depending on the shareholder's personal tax rate, this can be a more tax-efficient strategy than distributing additional taxable dividends or a salary. Since this tax gain harvesting strategy is complex, we would always recommend working with your accountant to determine whether it is appropriate for you. And last but not least, there are those tax loss selling pairs we use to avoid violating the CRA's superficial loss rules. Justin will dive into the details soon, and we'll share our current list with you. But before we do, it's worth mentioning that we regularly update our pairs whenever we spot better, newly launched substitute ETFs. For example, we recently changed VCN's replacement ETF from XIC to the Franklin FTSE Canada All Cap Index ETF, FLCD. So that's PWL Toronto's tax loss selling strategy in a nutshell. Thanks for listening, and if you have any additional tax loss selling questions, please feel free to leave them in the comment section of the Canadian Portfolio Manager blog.
Next up, what you've all been waiting for, another
ETF Kombat,
where we pit two ETFs against one another to test their might. In today's challenge, the Vanguard FTSE Canada All Cap Index ETF VCN will face off with the iShares Core S&P TSX Capped Composite Index ETF XIC. Although both ETFs provide investors with broad exposure to Canadian companies, there can be only one winner in this.
ETF Kombat, Round 1, Fight!
The biggest difference between VCN and XIC is how their underlying indexes treat foreign ownership restrictions. VCN's index, the FTSE Canada All Cap Index, acts as though a foreign investor is purchasing the underlying stocks, so it adjusts the weights of companies like BCE, TELUS, and Air Canada by their allowable foreign ownership limits. While this makes sense from a foreign investor's perspective, it makes little sense for us Canadians. FTSE does offer a domestic version of VCN's index, which addresses this issue, so it's odd Vanguard hasn't made the switch yet. XIC's index, the S&P TSX Capped Composite Index, doesn't apply these limits when weighting its companies. You get just the right amount of each stock for a Canadian investor. For this reason, we give the first round to our more Canadian fund.
XIC wins. Round 2, Fight!
You may have noticed the term capped in XIC's fund name. Not to be confused with market caps, the term indicates that all company weights will max out or be capped at 10% if they happen to get too big for their own good. This was the case with Nortel in 2000, when its uncapped value would have been a huge gorilla in the room, squatting on more than a third of the S&P TSX Composite Index. S&P launched its capped index in January 2001. Then, around the same time, Nortel's price steadily fell from $124 per share to only $22 per share between August 2000 through March 2001. After its 82% decline, Nortel ended up accounting for less than 10% of the index on its own. No security in the S&P TSX Composite Index has been above 10% since then, so it's essentially identical to the S&P TSX Capped Composite Index at this time. That said, it's good to know the cap is there if we ever need it. VCN's index includes no similar capping feature. But what about that all cap in its name? It just means it invests in large, mid, and small cap stocks. If a single company were to once again take up too much space in its index, investors could end up with another Nortel-like monkey on their back. Because of this feature, we'll award the round to the fund that knows how to keep a portfolio from going bananas by putting a cap on it.
XIC wins. Best 3 out of 5. Fight!
XIC is slightly more diversified than VCN, with 30 additional holdings. However, the number of extra companies can be misleading. They only account for between 3 to 4% of XIC's value. Plus, the majority of this allocation is represented by just 4 Brookfield limited partnerships. These Brookfield securities are missing from VCN's portfolio, as FTSE excludes limited partnerships from their indices. Even still, XIC offers a tad more diversification. Frankly, it's not enough to expect a noticeable impact on returns going forward, but hey, who are we to turn down any extra diversification we can get?
Finish it.
If Vanguard were to update VCN's underlying index to the domestic version of the FTSE Canada All-Cap Index, this would address its main downside. Although XIC's additional 30 holdings and 10% cap on individual companies are nice features to have, they're not absolutely necessary. Well, not unless some high-flying stock like Shopify takes over the index.
XIC wins. Frugality.
As many of you know, VCN is included in the Canadian Portfolio Manager and Canadian Couch Potato Model ETF portfolios. Eventually, we may decide to update our model portfolios by swapping out VCN for XIC. But if you're already holding VCN, please don't feel like you need to switch it to XIC, especially if there are capital gains implications for doing so. The tax costs could far outweigh any advantages. They are both still excellent choices for getting low-cost exposure to Canadian stocks. Next up, we'll circle back around and show you how to properly pair up similar but not identical ETFs for your tax loss selling strategy.
All right, Brain. You don't like me and I don't like you. But let's just do this and I can get back to killing you with beer. It's a deal.
As we explained earlier, tax loss selling means selling an existing ETF at a capital loss and then repurchasing a similar but not identical holding to maintain similar asset class exposure in your portfolio. Again, the new ETF must not be deemed identical to the one you just sold. If it is, you'll violate the CRA's superficial loss rules and lose the tax savings you're hoping to gain. To that end, it helps to have a good list of ETF pairs that offer you similar but different exposure to the same asset class. Look no further, my friends, because we're about to offer you just that. Due to the seemingly endless supply of new ETFs being launched, tax loss selling for Canadians has never been easier. We'll start with the most broadly diversified asset class ETFs for global, ex-Canada, Canadian, US, international, and emerging market stocks. We then suggest a replacement ETF that will provide similar market exposure without being deemed identical property. Oh, and as always, you should speak with your accountant or other tax planning specialist before engaging in any tax strategy. First, we're taking on a global ex-Canada equities pairing. For this, we're pairing XAW with VXC, but with a little surprise plot twist. The iShares Core MSCI All-Country World ex-Canada Index ETF, XAW, is a familiar fund among do-it-yourself investors, featured in the Canadian Couch Potato and Canadian Portfolio Manager model portfolios. XAW follows the MSCI All-Country World ex-Canada Investable Market Index. This index tracks the performance of large, mid, and small-cap companies in the emerging and developed markets, excluding Canada. The Vanguard FTSE Global All-Cap ex-Canada Index ETF, VXC, is the best XAW replacement for tax loss selling purposes, as it also tracks large, mid, and small-cap companies across the world, excluding Canada. From 2009 to 2018, both ETFs' underlying indexes had a low monthly tracking error of 0.065%, indicating similar expected performance going forward. In other words, if you create a line graph charting the performance of each over the past decade ending in 2018, the two lines have been so similar that they end up looking like a single line. They've tracked one another that closely. By the way, tracking error is often used to describe the size of a fund's outperformance or shortfall. Without getting too technical, I'm using a more technical application of the term based on the standard deviation of the differences in their monthly returns. As used in this podcast, the lower the tracking error, the more closely two indexes track one another. Now for that surprise. Until very recently, VXC had a higher management expense ratio than XAW, 0.27% versus 0.22%, and higher expected foreign withholding taxes in a taxable account, 0.13% versus 0.04%. This meant that most tax loss selling investors would have preferred to switch back to XAW once the 30-day holding period had been satisfied. Plus, we would have encouraged investors to only realize a loss on XAW if it was at least $10,000 and 10% of the book value. But then, just as we were preparing this podcast, Vanguard announced it was fixing VXC's tax inefficiencies and lowering its fee. With this update, we can now change the loss threshold to $5,000 and 5% of book value, with no need to switch back to XAW. Way to go, Vanguard. Next up, let's look at Canadian equity pairings. Here we can pair VCN with FLCD, but as we'll describe, FLCD can also pair with XIC and ZCN. Buckle up, we're about to take you on a tour through all of these possibilities. So first, if you're currently holding the Vanguard FTSE Canada All-Cap Index ETF, VCN, a suitable tax loss selling alternative would be the Franklin FTSE Canada All-Cap Index ETF, FLCD. Although both fund names suggest they track the same index, a closer inspection reveals they track slightly different ones. VCN follows the FTSE Canada All-Cap Index, which tracks the performance of 200 large, mid, and small-cap Canadian companies. FLCD tracks the FTSE Canada All-Cap Domestic Index, which also tracks the same 200 large, mid, and small-cap companies as VCN, but in slightly different proportions. The term domestic in the name indicates that this index does not adjust any company weights based on foreign ownership restrictions. In contrast, the FTSE Canada All-Cap Index does adjust the weights of certain companies within the index based on these restrictions. Governments impose limits to the foreign ownership of companies within certain industries when they feel it wouldn't be in the public interest, such as in the aviation or telecommunications sectors. For example, Bell Canada is subject to the Telecommunications Act, which governs the ownership and control of Canadian telecommunications carriers. The Act restricts foreign investment in voting shares of BCE to a maximum of 33.33%. If we view FLCD's holdings, Bell Canada has a weight of around 2.4% as of September 30th, 2019. VCN has a weight of only 0.8%. That's a third of FLCD's weight, which is the maximum foreign ownership of the company allowed. Another way to think of the difference between these two ETFs is that FLCD's index is a better gauge of what Canadian investors would consider to be the available Canadian stock market, while VCN's index is what foreign investors would consider as their available Canadian stock market. Knowing this, it's a bit surprising that Vanguard Canada hasn't shifted VCN to the domestic version of this index yet. From 2009 to 2018, these two indices had a monthly tracking error of 0.106%. This is a relatively small tracking error, which indicates they can be interchanged with little expected impact on future market performance. If you're considering a switch from VCN to FLCD to realize a capital loss, there's little reason to switch FLCD back to VCN after 30 days, unless another tax loss selling opportunity presents itself at the end of the required holding period. Both ETFs are expected to have similar returns going forward. Without knowing which ETF will slightly outperform over your future investment horizon, we'd recommend saving yourself the extra cost and hassle and hang on to the replacement ETF. Again, if you were to compare the growth of the FTSE Canada All-Cap Index and the FTSE Canada All-Cap Domestic Index from 2009 to 2018, the lines in the graph would be very similar, producing a modest shadow effect over the course of a decade. As I mentioned earlier, FLCD is also the best available tax loss selling replacement for either the iShares Core S&P TSX Capped Composite Index ETF, XIC, or the BMO S&P TSX Capped Composite Index ETF, ZCN. Both XIC and ZCN follow the S&P TSX Capped Composite Index, which tracks 233 large, mid, and small-cap companies in the Canadian stock market. As the name suggests, index weights are capped at 10%, avoiding that Nortel-like meltdown I mentioned earlier. If a single company were to one day become larger than 10% of the FTSE Canada All-Cap Domestic Index, we might see significantly higher tracking error between the two indices. The S&P TSX Capped Composite would cap the security at 10%, but the FTSE Canada All-Cap Domestic Index would continue to allow the stock's weight within its index to increase above 10%. And remember, another notable difference is FLCD excludes a number of Brookfield Limited partnerships, while XIC and ZCN include them. This is because FTSE indexes exclude limited partnerships, while S&P Dow Jones indexes do not. In terms of similarities, the S&P TSX Cap Composite Index does not adjust company weights with regards to foreign ownership restrictions. This makes it more similar to the FTSE Canada All Cap Domestic Index than to the FTSE Canada All Cap Index. This single difference has led to nearly identical performance from January 2009 to 2018. Over the same period, these two indices had a monthly tracking error of 0.118%. So what happens if Vanguard ever changes the underlying index for VCN to the domestic version at some point in the future? All else equal, we then prefer pairing XIC and ZCN with VCN for tax loss selling, so FLCD would no longer be needed. Now onward to U.S. equities, where XUU pairs with VUN. If you have decided on the iShares Core S&P U.S. Total Market Index ETF XUU for your U.S. equity exposure, we'd recommend the Vanguard U.S. Total Market Index ETF VUN as the most suitable tax loss selling replacement. XUU follows the S&P Total Market Index, which tracks the performance of around 3,800 large, mid, small, and microcap companies, making it one of the most diversified U.S. equity indexes. VUN follows an equally impressive index, the CRSP U.S. Total Market Index, which includes over 3,500 large, mid, small, and microcap companies. After switching from XUU to VUN, cost-conscious investors may prefer to switch back, as XUU has an annual management expense ratio of 0.07%, while VUN has an MER of 0.16%. We don't feel this is entirely necessary, but if you're planning to switch back after the 30-day period has ended, consider only selling XUU if it has a loss of $10,000 and 10% of the book value. This will increase the odds you'll still have an overall capital loss when you switch VUN back to XUU. From 2009 to 2018, the underlying indices had a monthly tracking error of 0.065%. As with our last example, this would generate a line chart over the past decade where the indices' two lines mostly overlapped. Moving overseas, we'll consider international equities next. Here, XEF pairs with ZEA, sort of. Suitable tax loss selling pairs for international equity ETFs are harder to come by than for Canadian or US equity ETFs. Many investors might consider a pairing between the iShares Core MSCI EFI IMI Index ETF, XEF, and the Vanguard FTSE Developed All Cap ex North America Index ETF, VIU. After all, they both track over 3,000 large, mid, and small cap companies in developed countries outside of North America. However, index providers FTSE and MSCI differ in which countries they consider to be developed. The most obvious example is South Korea, which is classified as a developed market by FTSE, but an emerging market by MSCI. As VIU follows a FTSE index, it allocates more than 4% of its portfolio to over 400 Korean companies, while XEF, which follows an MSCI index, has no Korean companies in its fund. This difference has led to a higher monthly tracking error than our previous tax loss selling pairs at 0.226%. Alternatively, investors could consider switching from XEF to the BMO MSCI EFI Index ETF, ZEA. Both ETFs track an MSCI index, which avoids the South Korea country classification issue just discussed. But ZEA does not invest in small cap stocks, which is expected to result in future return differences relative to XEF. From 2009 to 2018, the underlying indices had a monthly tracking error of 0.171%. This is lower than our XEF VIU pairing, so that suggests it's a more optimal tax loss selling pair. However, the index performance during this 10-year period was noticeably different. So if you go this route, you may want to consider switching back to XEF after the 30-day period has passed if you intend to maintain broad market exposure. If you plan to switch ZEA back to XEF after 30 days, a $10,000 and 10% tax loss selling threshold is recommended. And last up, there's emerging markets equities. For emerging markets, XEC may not pair so well with VEE, so we'd suggest pairing it with ZEM instead. Unfortunately, the same country classification issue arises with emerging markets indexes. So at first glance, you might think you could replace the iShares Core MSCI Emerging Markets IMI Index ETF, XEC, with the Vanguard FTSE Emerging Markets All Cap Index ETF, VEE. Both underlying indexes follow thousands of large, mid, and small cap companies in emerging markets across the globe. However, XEC follows an MSCI index, which considers South Korea to be an emerging market. so it allocates more than 12% of its fund over 400 Korean companies. On the other hand, VEE, which follows a FTSE index, considers South Korea to be a developed country and allocates these stocks to its developed markets ETF, VIU. This difference has led to a relatively high monthly tracking error from 2009 to 2018 of 0.544%. Long story short, we believe a better tax loss selling pair for XEC would be the BMO MSCI Emerging Markets Index ETF, ZEM. ZEM follows the MSCI Emerging Markets Index and includes large and mid-sized companies from emerging markets around the world. As both ETFs follow MSCI indexes, they both include South Korean companies in their funds. The monthly tracking error from 2009 to 2018 for their underlying indexes was 0.213%. which would indicate they make a better couple than XEC and VEE. Now, we're the first to admit our tax loss selling pairs for international and emerging markets equity ETFs are not ideal. The replacement BMO ETFs exclude smaller companies, while the original iShares ETFs include large, mid, and small cap stocks. If MSCI upgrades South Korea to developed market status, we wouldn't have this problem. We could switch XEF to VIU or XEC to VEE, knowing that the future performance of our replacement fund would likely closely track our original ETF. Until that happens, we're stuck with these next best tax loss selling pairs for international and emerging markets ETFs. But at PWL, we're not fans of good enough, so we've come up with some improved, albeit more complicated, pairing proposals. For tax loss selling purposes, we've adjusted our rules slightly to treat XEF and XEC as if they were a single holding. If the net unrealized dollar losses on the combined holdings of XEF and XEC are greater than $5,000, and the total percentage loss of both holdings is greater than 5%, we consider the threshold met. We would consider selling all units of both XEF and XEC, repurchasing VIU and VEE with the proceeds, even if the loss on one of the two ETFs is not above our tax loss selling threshold, and even if one of the ETFs has an unrealized capital gain. This relaxed rule allows us to realize the overall capital loss for our clients, maintain similar broad market equity exposure, and keep the CRA from crying foul. The trade-off? It involves more number crunching. Let me provide you with an example so you can decide for yourself which way you'd like to go. Suppose you bought XEF and XEC in September 2018 for a total cost of $108,000. At year-end, the value of XEF and XEC fell to $73,000 and $27,000 respectively. You'd now have a total market value of $100,000 and a total unrealized capital loss of $8,000. XEF's unrealized dollar loss is $7,000 and its percentage loss is 8.8%. It is now a potential tax loss selling candidate, so it could be switched to ZEA to realize the loss. On the other hand, XEC's dollar loss is only $1,000 and its percentage loss is only 3.6%, both of which are under our 5,000 and 5% tax loss selling thresholds. However, if we consider XEF and XEC to be a single position, their total dollar losses of $8,000 and percentage losses of 7.4% would meet our tax loss selling requirements. After selling XEF and XEC, VIU and VEE will immediately need to be purchased, but in slightly different proportions. To determine the appropriate market cap weights, you'll need to use the most recent month-end index fact sheets from FTSE Russell indices. Currently, the approximate splits are 73-27 for XEF XEC and 75-25 for VIU VEE. You'll need to buy a higher percentage of VIU than XEF and a lower percentage of VEE than XEC because the additional South Korean companies are held in VIU, not in VEE. In this simplified example, $75,000 of VIU and $25,000 of VEE would be purchased with the sale proceeds of $73,000 from XEF and $27,000 from XEC. These investment amounts would provide approximate market cap weighted exposure to international and emerging markets. The relative index weights fluctuate daily, but using the latest month-end index fact sheets should be close enough for our purposes. And by the way, I'll be posting a blog version of this section of the podcast, so check out that post if you'd like to see all of this data in a handy table format. You'll also be able to peek at all those index line chart comparisons I mentioned earlier on. before we reach the end of today's long, winding podcast, there may be one more burning question still on your mind. What about asset allocation ETFs, and how do they fit into tax loss selling? Vanguard's asset allocation ETFs were launched in January 2018 and have become a popular choice for do-it-yourself investors. Unfortunately, the fact they are not ideal vehicles for tax loss selling may be one of their very few downsides. Take the Vanguard Balanced ETF portfolio, VBAL, for example. Let's say you had purchased $1 million of the fund at the end of January 2018, shortly after its launch. There would have been only 3 days in 2018 when the fund showed a loss of at least $5,000 and 5% of its book value. These days were December 20th, December 21st, and December 24th. There were no days when the loss was at least $10,000 and 10% of the book value. On those December days, you could have switched to a similar fund, like the iShares Core Balanced ETF portfolio, XBAL, keeping in mind that the wet paint was still drying on this fund too at around the same time. Unfortunately, had you switched XBAL back to VBAL after 30 days, you would have realized substantial capital gains due to the stock market recovery in January 2019. This would have offset the majority of the capital losses from your initial tax loss selling trades. Also, the trading costs due to the ETF's bid-ask spreads would generally be higher when trading an asset allocation ETF relative to trading the individual underlying ETFs. You're technically forced to buy and sell all of VBAL and XBAL's underlying ETF holdings behind the scenes, including the bond ETFs, which would not have been trading at large losses. If you had instead purchased VBAL's underlying ETFs in similar proportions, there would have been many more tax loss selling opportunities to take advantage of throughout the year, and no need to switch back to the original ETFs. There were 33 days during 2018 where VCN would have been trading at a loss that breached their tax loss selling thresholds. VUN also had a few days when it qualified for tax loss selling. Combined, VIU and VEE spent an impressive 84 days in the proverbial danger zone. On any of these days, you could have taken action to realize some capital losses. This would have been especially useful if you had already realized substantial capital gains when transitioning your $1 million portfolio to low-cost ETFs. So if you happen to be in a similar situation, and you don't mind the added complexity, it could make sense to consider purchasing a handful of ETFs instead of an asset allocation ETF in your taxable account. This would increase your chances of stumbling across tax loss selling opportunities to offset the capital gains realized in your portfolio transition. That said, the hassle factor is worth calculating into your costs too. For many, a simple asset allocation ETF may still be your preferred route. To reinforce everything I just covered, this next section will summarize all of it. Dedicated to my fellow Redditors, it's called TLDL, or Too Long Didn't Listen. Are you ready? Here goes. Tax loss selling is only relevant in taxable accounts, not in your registered or tax-free accounts. Check the accuracy of the adjusted cost base on each ETF before implementing a tax loss selling strategy. Don't sell an ETF at a loss and buy back the same ETF. This is called a superficial loss and won't fly with CRA. Don't sell an ETF at a loss and buy back an ETF that tracks the same index, or the loss may also be denied. So don't sell XIC and buy back ZCN, as they both track the S&P TSX Capped Composite Index. You can avoid the superficial loss rule by selling an ETF and buying back another ETF that tracks a similar but not identical index. The period that runs 30 calendar days before and after the settlement date of your tax loss selling trade is very important. If you or your spouse or a corporation controlled by either of you buy any shares of the same ETF during this period and still own the shares at the end of this 61-day period, a partial or full superficial loss may apply. Review the buy transactions across all family accounts in the 30 calendar days prior to the expected settlement date before placing your tax loss selling trade. Look out for partial superficial losses when buying ETFs and other accounts during the 30 days after placing your tax loss selling trade. A typical error could involve selling an ETF at a loss at year-end and repurchasing the same ETF back in your TFSA when you max it out in January of the following year. The tracking error of the replacement ETF shouldn't be an issue if you use our recommended tax loss selling pairs. They've been chosen to provide similar exposure and returns going forward. Dividend reinvestment plans, or DRIPs, may cause partial superficial losses when tax loss selling. Cancel all DRIPs in your accounts to avoid this issue. Multiple portfolio managers can also cause superficial losses, especially if they all use similar ETFs. If you're managing an ETF portfolio at a discount brokerage and a robo-advisor manages some of your family's accounts, this could cause issues. Keep an eye out for tax loss selling opportunities year-round. If that's too much of a pain, aim for monthly or at the very least annually each December. Consider placing a tax loss selling trade if your ETF is showing both a loss of $5,000 and a 5% loss on its book value. If you're planning to switch back to your original ETF after 30 days, increase this threshold to $10,000 and 10%. This increased threshold will account for the possibility of a significant market recovery during the 30-day waiting period, where you would be forced to realize a capital gain when switching back to the original ETF. Consider realizing capital losses, even if you have no capital gains in the current year or the 3 prior years. These can be used to offset future year-end capital gains distributions, gains realized during occasional portfolio rebalancing, and can provide more flexibility when switching to newer, cheaper, and more tax-efficient securities. If you invest in a corporate non-registered account, speak with your accountant first on whether tax gain harvesting rather than tax loss selling would be more appropriate. And for our recommended tax loss selling pairs, XAW pairs with VXC. VCN, XIC, and ZCN all pair with the Franklin FTSE Canada All Cap Index ETF, FLCD. Stay invested with replacement ETF, as long-term returns on these ETFs are expected to be similar. XUU pairs with VUN. Although VUN is more expensive, we'd suggest just leaving your investment with VUN after 30 days, unless another tax loss selling opportunity on VUN arises. XEF doesn't have an ideal tax loss selling replacement. Neither does XEC. Instead, treat XEF and XEC as if they are one ETF. If the overall loss on the combined ETFs is at least $5,000 and 5% of the book value, sell both of them and purchase VIU and VEE. Don't bother switching the VIU-VEE combo back to XEF-XEC after 30 days, as their exposures are similar. As VIU includes South Korean stocks while XEF excludes them, you'll have to adjust your weights for similar exposure. If you're aiming for market cap exposure for your international and emerging markets equity allocation, an approximate percentage split of 73-27 for XEF-XEC would currently be equivalent to a 75-25 split for VIU-VEE. Asset allocation ETFs are not efficient for tax loss selling. If you realize big gains switching to a passive ETF portfolio, consider purchasing individual equity ETFs for your Canadian, US, international, and emerging markets equity exposure. This is expected to increase your tax loss selling opportunities and may also decrease your trading expenses from bid-ask spreads when tax loss selling occurs. And if you're still listening right now, I guess this wasn't too long after all. See you next time.